Sensitivity of bond prices to interest rates. Investors in bonds think a lot about what other investors in the market for bonds are doing. Indeed, the extent to which other investors in the market for bonds discount future payments impacts the price of your investments. But how can we figure out how much a bond's price will fall in value for, say, a 1 percentage point change in the bond's yield to maturity? Suppose we have a standard coupon bond with a face value of $1,000 and an annual coupon rate of 8% paid semi-annually, or $20 for every 6-month period. So 4% is the semi-annual rate. If markets discount the cash flows at an 8% bond equivalent annual yield, or a 4% semi-annual yield, then the bond will cost exactly $1,000. Now, if you were doing this in 2013, you could say that this was clearly not a treasury bond. The last time the 10-year treasury yield was over 8%, it was 1991. But this could be a bond issued by a corporation or other riskier entity, and investors require some compensation for investing in these securities instead of treasuries, which is why the yield would be higher. So the bond starts out trading at par, or at an 8% yield to maturity for a price of $1,000. Now, for a 1 percentage point increase in the yield to maturity, you will find that this bond's price falls by 6.5%. For a 2 percentage point change in the yield to maturity, it falls by 12.4%, which is less than 2 times the impact of the 1 percentage point change. And for a 3 percentage point increase in the yield to maturity, it falls by 17.9%, which is quite a bit less than 3 times the impact of a 1 percentage point change. So each additional percentage point increase in the discount rate continues to impact the bond price adversely, but does so with decreasing strength. On the other side, a 1 percentage point decrease in the yield to maturity increases the price of the bond by 7.1%, which is more than the decline experienced if the yield to maturity rose by 1 percentage point. For a 2 percentage point decrease in the yield to maturity, the price rises by 14.9%. And for a 3 percentage point change, it rises by 23.4%. So here, the change in price for each additional decline in interest rates is actually more than linearly proportional. That is, the 14.9% is greater than 2 times the 1-year change of 7.1%, and 23.4% is more than 3 times the 1-year change of 7.1%. Let's add the comparable analysis for a zero coupon bond, also with a 10-year maturity. This one is more sensitive to changes in price. And here I'm also going to add in both coupon and zero coupon bonds with a much longer maturity, 30 years, to examine their sensitivity to prices. The 30-year bond prices are much more sensitive to yields than the 10-year bond prices, and the 30-year zero coupon price is much more sensitive to yields. So the bottom line so far that we've observed is that for a given maturity, a coupon bond is less sensitive in price than a zero coupon bond, and a long maturity bond is more sensitive in price than a short maturity bond. Now, despite the curvature in the lines or convexity that we see here in these graphs, it turns out that we can write a pretty good linear approximation as follows. The percent change in price equals negative the duration times delta 1 plus r over 1 plus r, where r is the initial yield to maturity on the bond, and duration is a constant that I'll explain in detail in a minute, formerly known as the Macaulay duration. So the formula says that the percent change in price can be approximated by multiplying a constant, this duration, by the percent change in the gross interest rate. This object on the right, delta 1 plus r over 1 plus r, or the rate of change in the gross interest rate, is quite close to the level change in the discount rate in percent, so just delta r, just slightly smaller. Now, what is the duration? Duration, it turns out, is the weighted average maturity of the cash flows. For a zero coupon bond, duration equals maturity because there's only one cash flow. For a coupon bond, duration is less than the maturity, since lots of cash flows are being returned to the investors before the maturity of the bond. For example, take the 10-year coupon bond we've been discussing. To find its duration, we need the weighted average maturity of the bond's payments. The weights are the proportion of the present value of each payment in the bond's total value. So taking a weighted average of the maturity of each payment, we find that the duration is 7.07 years, or 14.13 half years. Now let's look at the payments of the 30-year bond with the same coupon. The duration here is, once again, the weighted average maturity of the payments, which turns out to be 11.76 years, or 23.53 semi-annual periods. Note that this is a lot less than 30 years. A big piece of this bond's present value is returned to the investor long before 30 years have passed. So holding all other things equal, longer maturity bonds can typically be thought of as having higher duration. That's not true in every case, but is in most cases. And bonds with higher coupons, other things equal, can be thought of as having lower duration. How does the duration approximation perform relative to the actual percent change in price that we can expect from changes in interest rates? Well, as you can see from the formula, the duration approximation is a linear approximation. Here is a graph of the actual percent changes in the prices of the 4 bonds relative to the change in rates as measured in the duration formula. The curvature in these lines is called convexity. Convexity is the fact that the bond gains more in value for a 1% drop in interest rates than it loses for a 1% rise in interest rates. The duration formula approximates this convex relation with a linear relation, as we can see most clearly if we look at the percent change in the price of the 30-year zero coupon bond. Other things equal, zero coupon bonds display the most convexity. Consider the 10-year coupon bond, where convexity is lower than for the 30-year and the approximation is better. We found above that this bond has a duration of 14.13 half years. The approximation tells us that for a 1% change in yield, we'll have a 14.13% change in price. And indeed, when the yield falls by 1 percentage point, the price increase is, well, a little more than 14.13%. It's 15.5%. And when the yield rises by 1 percentage point, the negative effect on price is, well, a little less than 14.13%. It's 12.9%. But this 14.1% is not too bad in approximation, and it's very simple to implement. Now, instead of working with the somewhat complex object, that is the rate of change in the gross rate, this delta 1 plus r over 1 plus r, we can instead work with the simple change in the interest rate in percentage points if we define modified duration as the following. Modified duration equals duration over 1 plus r, where r is the initial yield to maturity of the bond. This is a nice trick because if we use this modified duration, then the percent change in price simply equals negative the modified duration times delta r, where delta r is just the level change in the yield in percentage points. The modified duration of the 10-year coupon bond is 14.13 divided by 1.04, which equals 13.59 semi-annual periods, or around 6.8 years. So a 1 percentage point change in the annual yield is estimated to have a 6.8% effect on the prices. In fact, such a yield drop increases the price by 7.1%, and a similar yield increase drops the price by 6.5%. Again, 6.8% turns out to be not a bad approximation and very easy to implement. To recap, in this section we've learned about the tool of duration as a useful way of measuring the sensitivity of a bond's price to the interest rate. This is useful in many contexts, including bond investing, and also understanding the sensitivity of pension liabilities to discount rates. What is the duration of a stream of cash flows? It is really just the weighted average maturity of these cash flows. And if we divide that by 1 plus the yield to maturity, we get the very convenient object called modified duration. A 1 percentage point change in a bond's yield to maturity generates a price change in the bond that's approximately equal to this modified duration. This is a highly useful tool for understanding the price risk in owning bonds.